Sabrina. Nice to meet you. Good afternoon.
Désirez-vous que j'effectue la lecture des consignes en anglais ou en français?
En anglais.
Each team has 20 minutes to present the case to the judges. I will show a mark for the 10, 5, the last 2 minutes, and the last 30 seconds of the presentation. During the last 10 seconds of the speech, I will indicate by means of my two hands the number of remaining seconds. A team not having ended its presentation after 20 minutes will be stopped to move on to the period of question. The period of question of a maximal duration of 5 minutes is assigned to the jury at the end of the presentation. I would like to remind the jury that it's mandatory to ask at least one question during this period. I will invite the judges to introduce themselves and then the team will begin.
Okay, so my name is Pierre Leblanc. I'm a tax manager here for a local firm in town called Boutreau-Savoie. I'm a former student of University of Moncton. I participated in the games before, so I know what you guys are going through. I wish you guys all the best.
Hi, I'm Pauline Boudreau. I'm the senior tax manager for EY here in town, and I wish you good luck with your presentation.
Good afternoon, everyone. My name is Sabrina Lapierre. I'm a senior tax analyst with Signon here in Dieppe. I was in your shoes before too. It's interesting today to be on the other side and listen to your presentation. I'm very happy to be here, and I look forward to it.
Thank you.
Thank you.
So as the saying goes, there are plenty of fish in the sea, or in your case, plenty of fish in the aquarium. We are here today from 88 LLP to ensure that you're able to secure the catch of the day with your tax planning strategies. Hi, my name is Anastasia. I'm here with my colleagues Dan and Derek, and we are here today to help with the sale of Aqua Inc. to Fishnet and some of the negotiating strategies and ideas to put forth when speaking with Fishnet. So just before we get started, we have two key objectives that we hope to hit today. The first one is tax savings. So we want to reduce your overall total tax liability. And secondly, we want to defer your current tax liability as far as possible into the future. So I'll go through an overview of what we hope to achieve today. Firstly, we'll be talking about the sale of Aqua Inc. to Fishnet, so whether that be through the sale of shares or through the sale of assets. And we'll be providing you with different scenarios and reasonings to help you negotiate and discuss with Fishnet the best alternative for both parties. Secondly, we'll be going over the tax liability for 2016, so based on the financial statements provided, as well as some additional information we require to able to successfully complete the tax filing for 2016. And finally, we'll discuss some more personal tax planning opportunities. You did place a significant emphasis on your family and benefiting them in the future, and therefore we'll discuss some opportunities you have there in regards to your current business and corporate structure. So now I'll be passing on to Dan, and he'll be discussing the sale of Aqua Inc.
Thanks, Anastasia. So as mentioned, you've been approached by Fishnet with an opportunity to sell your company. Now they only want certain assets. However, we're going to try and find a way to get the best possible deal for you from a tax perspective as well as from just a regular business standpoint as well. So there's kind of two alternatives. There's the sale of shares or the sale of assets. So we're going to analyze the pros and cons of each. So for sale of assets, there's several advantages, but mostly are for the purchaser, so in this case, Fishnet. So in this case, Fishnet, by purchasing just sales, their advantages are they are able to purchase the different assets at a higher ACV because they'll be purchasing them at the fair market value, which is higher than the current ACV. And this will allow them to take more CCA in the future as they are able to depreciate this higher value. They also are able to acquire only the desired assets. So as they mentioned, they were sort of focused on your goodwill and some of your customer lists and stuff like that. So this presents probably a more ideal situation for them since they don't really want your land or your buildings and whatnot. Finally, Fishnet will be able to purchase goodwill. And whereas if they only purchase it through shares, goodwill would still be internally generated. So this wouldn't be an item on their balance sheet. They wouldn't be able to take a deduction on it for CCA. And this would be under Class 14.1, which is a fairly new which is a fairly new change from the Liberal government this year. So they take CCA instead of CEC, which was what it was in the past. While this isn't as beneficial for them as it was in the past, it still presents a huge opportunity because they'll be able to deduct some portion. They'll be able to take tax depreciation on some portion of the goodwill. Disadvantages, so for Aqua as the seller, they still continue to own all the assets that they did not purchase. So obviously this means what are they going to do with them? What's to come for these assets, and what's the tax impact? They're unable to use the lifetime capital gains exemption and the multiplier that would come through the trust. There's a potential CCA recapture, which would result in a business income. And it's also a complex and more costly transaction because sale of shares is one item, whereas you got to negotiate, you got to use lawyers and more accountants, and there's more fees associated with selling assets. So now moving on to sale of shares. The advantages, these mostly benefit the seller, so in this case, Paul. So first, they're able to use the lifetime capital gains exemption and the multiplier from the trust, which would result in significant tax savings. It results in a full transfer of the company, so they're not stuck with any of the shares and whatnot. It's also a much simpler transaction. However, it is very unfavorable for Fishnet, so they might not be willing to proceed with the sale, with the purchase of shares if it is not to their liking. So moving on, one of the major points we mentioned was the lifetime capital gains exemption because this results in the largest tax savings opportunity. There's two tests, and basically what happens is the corporation has to qualify as a QSBC, so a qualified small business corporation. So there's two criteria. 90% of the fair market value of assets must generate active business income in Canada, and for the prior 2 years, 50% of the fair market value of assets must generate active business income in Canada as well. So currently, by looking at your financial statements that were provided, we realized that there were no non-active business, there are no non-active assets. So there was no vacant land, investments, excess cash. So what this means is that they do qualify as a qualified small business corporation. And this is great because it means that they qualify to take advantage of the lifetime capital gains exemption, which would be approximately $824,000 exemption on capital gains per beneficiary of the trust. So Paula, your 3 children, and your spouse would all be able to give their lifetime capital gains exemption, and the capital gains on the sale of the QSBC shares would be exempt. And this results in approximately a total tax saving of $200,000 per beneficiary. So approximately 50% tax rate, and capital gains are taxed at 50%. So that's how we get to $200,000. And what this means is potentially, depending on the selling price, could result in approximately $1 million in tax savings since there's 5. So moving on, as we mentioned, there was the 2 options. The most beneficial for Aqua Inc. and you, Paula, is to go with the sale of shares. And this is clear, especially just with the lifetime capital gains exemption, made it really clear because of the immense tax savings. So going forward, one thing to keep in mind is that while you may not be able to sell them all they may not want all of your assets, there's some room for negotiation, and it could result in potentially some kind of hybrid transaction that could kind of have some give and take from both parties and result in a beneficial outcome for both. So one other thing we want to mention is a value for the Aqua Incorporated shares. So we started off by taking the fair market value of the property, plant, and equipment and the goodwill, which was about $2.4 million. We took out the fair market value of the undesired assets that Fishnet did not want, and this resulted in goodwill of approximately $1 million. So what we did then was take the net assets, which was about $2.7 million, and we took out the undesired amount. And what this resulted was an estimated value of the shares. And what we were able to do then is figure out a value for the shares if Paula, you were able to find a way of getting these assets out of the corporation. And this would result in a potential opportunity to satisfy both parties. So now I'm going to pass it over to Derek, who's going to further discuss this.
Thank you, Daniel. So as mentioned, I'll be going into a little bit further exactly how we're going to satisfy both sides in this negotiation. So first and foremost, we have these 3 alternatives. Either Fishnet acquires all of the assets, we transfer or sell the undesired assets, or we dividend in kind the undesired assets. All of this will happen before the sale takes place. So the first one is Fishnet acquires all the assets. And under this alternative, it's not very realistic because we would be forcing them to take on those assets that they specifically listed as ones they did not want. So because of this, it's not a realistic alternative, and it's not necessarily one which we will be able to push further on unless we take a significant hit in the selling price of the assets when we transfer them to Fishnet. Now we'll move on to transfer of sale of undesired assets. So looking at the transfer of undesired assets, this would be beneficial because we could do a Section 85 rollover of these assets to your Tools Plus Inc. Corporate beneficiary. So this is a holdco which you mentioned that you had in place. And so the opportunity to roll it over from Aqua Inc. to Tools Plus is something that you could do in order to maintain the tax value. As a result of this, you could receive a loan as consideration, Aqua could receive a loan as consideration for these assets which are transferred out. And this would help facilitate the transfer because otherwise you would need an abnormal amount of cash. Once a loan has been received, you'll be able to once a loan has been received, then you'll be able to have the assets in place at Tools Plus Limited or Tools Plus Inc. And once they are there, you have the opportunity to either potentially sell them or continue to use them. As you mentioned, you do have the desire to continue on in other businesses, and it's possible that this land and this equipment could be beneficial to you in the future and could be used for purposes other than Aqua Inc. Other than at Aqua Inc. So moving on to the dividend in kind, there's also the possibility to issue all of these assets to your family trust. So because of this opportunity, the Aqua Inc. would have to recognize a capital gain. However, some of the equipment and the vehicles are actually in fact at a loss as it currently stands, and this loss does outweigh the gain that the building would be otherwise incurring. So as a result, you will have a net capital loss of $16,000. Also, because of CCA, aka your tax depreciation, you'll have a terminal loss of about $66,000. This $66,000 will be eligible to be used against business income in the year, in the 2017 fiscal year. So as a result, you'll be able to lower your income, and as a result, you'll really be able to lower your taxable, or how much tax you will be paying. However, it's important to keep in mind that the $16,000 of capital loss will have to be used up in 2017, as will the $66,000. Otherwise, they will not be able to be carried forward to Fishnet, which is something you might want to consider doing to use the $16,000 against any other capital gains that the company might incur in the year. And as a result, once again, once you have dividend in kind these to the trust, you will have the opportunity to either sell them or to continue using them. But it's important to keep in mind that any potential gains or losses that might occur. So now I'll be going over the Aqua Inc. tax liability for the 2016 fiscal year. And so what you mentioned to us is that there's missing information that you wanted to know about, that you wanted us to address in order to determine exactly how much tax savings we could come up with for you. And so there were four areas four areas of missing information that we found that could really help in creating tax savings for you in the 2016 fiscal year. First and foremost, there's a small business deduction requirements. What the requirements are is that you should have at least 5 employees working at Aqua Inc. You need $15 million in Canadian assets, and you need $500,000 in business income in the year. If you fail to meet this criteria, you are ineligible for the small business deduction, and you will be paying a higher tax rate in the year. The life insurance beneficiary is something that you also mentioned to us, because you are currently expensing life insurance at Aqua Inc. However, for tax purposes, this is not allowed to be deducted unless Aqua Inc. is considered the beneficiary of your life insurance policy. This is because this is often done because if you mean so much to an organization that should you pass away, they would need to be able to have enough money in order to close up shop and close the company. Therefore, it's important for us to ensure that Aqua Inc. is in fact a life insurance, or is in fact the beneficiary of this life insurance policy in order to deduct the expense for tax purposes. Bad debts expense and allowance for doubtful accounts is another area that we determined that there's missing information. While you did deduct a bad debt expense for the year, only those expenses which have been written off are allowed to be deducted, and there's a provision which we need to calculate in order to determine exactly what the expense or deduction for tax purposes is that we're allowed to take. And then finally, there's the travel expenses of your spouse, which, as mentioned, or which you mentioned that you took at least $4,000 of expenses for related to Aqua Inc. and related to a business trip for Aqua Inc. However, because your spouse does not work there, you'll notice that we're going to mention that it is not allowable for tax purposes. So here we have the estimated tax liability, and essentially what we went through is the estimated liability outright. That's with the small business deduction. So you'll notice that the Part 1 tax rate there is 10.5%. That's federally, and of course, depending on which province you're operating in, then it could go up by as much as 15%. In the middle column, you'll notice that there's the insurance policy, and you'll notice that the insurance is blanked out into zero. So that's just to show the effect that if Aqua Inc. is not in fact the corporate the beneficiary of your life insurance policy, that's the tax effect it would have. Roughly $2,000 of additional tax would be due. And finally, under the no small business deduction, you notice that the tax rate increases to 15%. So as a result, you'll have to pay an additional tax of close to $22,000 in the year. You'll also notice that under other spouse travel, we've X'd it out as zero because as mentioned, we still need that information. And I'll be passing on to Anastasia to go over additional personal planning.
Perfect, thanks Derek. So now we're going to talk about some additional tax considerations, more on the personal level to benefit you personally as well as your family members, since you put such a great emphasis on that. So firstly, we're going to be talking about transferring some funds from Aqua Inc. to yourself personally. So we can do that through CDA, which is capital dividend account, a GRIP balance, so that's just a dividend balance account that will provide you with a greater effective tax on that dividend, and finally your RDTOH balance. So firstly, a capital dividend account, so we suggest that you pay out these funds, which is approximately $10,000 before the sale. So this will be $10,000 tax-free that you will receive. And in addition, if some assets are sold prior to the sale of Aqua Inc., you'll actually be able to increase your capital dividend account by 50% of the capital gain on that sale. Secondly, we'll talk about GRIP. So this is an eligible dividend that can be paid out to you personally, and it is just more effective tax rate. It will only be effectively 40% as opposed to 45% for ineligible dividends. Finally, we'll talk about your RDTOH balance. So your RDTOH balance is essentially a refund that you get on taxes previously paid on income. So once you distribute out this income that you'd previously paid taxes on, the corporation will actually get a refund on those original taxes paid. So we would suggest that these funds be paid out firstly before you could proceed with the sale of Aqua Inc. In addition, one key thing to notice for the transfer of funds is that we also noticed that there was a shareholder loan on your liabilities, so that must be paid back within 2 years, just one key note to include as well. In addition, we thought we'd talk about some income splitting opportunities, especially between yourself and your spouse. So you did mention that your spouse did perform some services for Aqua Inc. We suggest that there should be a payment of a salary for the services performed. This just provides a benefit for the corporation as well, so you're able to deduct his salary as a business expense. There's the ability as well as if he's performing business activities, his travel expenses can also be deducted, which previously we were unable to do so. And finally, there's the ability to income split between the two individuals. So therefore, your total household income could be the same level, however, it could be split more equally between yourself and your spouse. Now we'll touch on some retirement planning. So this is now estate planning, future planning for your family. Your spouse's salary is currently about $120,000 per year. So therefore, he is creating considerable amount of RSP room He did mention that he does contribute his full amount every year, and we believe he should continue to do so, as well as contribute to an RSP or spousal RSP, so he can be able to income split that in the future, so upon retirement and withdrawal. In addition, Paula has a minimal contribution because her salary is only $20,000. So this is again another opportunity to potentially create some mix of dividends and salary, which we can continue to calculate if you so choose to continue down this route. Finally, we're going to talk about the transfer of Tools Plus Inc. So this is just something that we believed would be a great benefit of transferring the shares that Paula you own personally and transferring them over to the trust. So we will actually sell these to the trust, and we made an assumption in this case is that since that the Tools Plus Inc. does not have any assets or does not have significant fair market value to these shares, you'll be able to transfer it over for a nominal value. This would be done before the transfer of the assets or the sale of assets from Aqua Inc. to this company. So this is just an additional opportunity to consider because you'll be able to continue with the tax-free dividends through being the corporate beneficiary and owned by the trust. So finally, we thought we'd talk about some education planning. So, and again, you can do this. We see that you have 3 children, all under the age of 18. So we believe that you can either do this through RSP contributions, where you get a grant from the government, or through the family trust. So if they're over 18, you can distribute that to them so they don't have kiddie tax applied to them. So thank you for your time today. We hope we were able to achieve these tax objectives of tax savings and tax deferral, and you are able to have the cash of the day. Thank you.
So one of your recommendations was to keep, so that Stephen keeps maximizing his RSP, and then you mentioned something about a spousal contribution. Will he be able to do both? Should he just do one? What exactly do you recommend on that front?
So for the spousal RSP, what happens is that he uses his own contribution room to contribute to the spouse's RSP because she had, we noticed that her salary was much lower. I think it was about $20,000 this year. She doesn't have a lot of contribution room for herself. So by doing that, and he likely has a pension since he works at the university. So we thought that by contributing to the spousal RSP, they'll be able to split income upon retirement. Because she'll have an RSP and he'll have an RSP, and then at that point, because her RSP is probably much lower, it'll be taxed at a lower rate since he probably has much more retirement income at that point.
So he should stop contributing to his own and contribute to his spouse?
Maybe not fully, but it's a good idea to split it up so that there is some mix. And it, again, depends on we didn't have any information on how much pension and whatnot since he works at the university, so it kind of depends on what he's expecting for his retirement income, but I think there's some sort of allocation which we could figure out with more information.
Can we go back to where you rolled over the assets to the holding company under Section 85? Is that going to be tax-free, or should, because I think there was a note that you were going to issue? Can we go back to this?
Oh yeah, I can go back, no problem. So it will be this one.
Yeah. So is that rollover going to be tax-free, or will Aqua have to pay tax on the disposition of those assets?
So essentially under Section 85, they'll be able to roll it over at its, well, it could be at its, up to its fair market value or from its ACV, so depending on what value it's chosen to roll over at. And again, in addition, they will receive a loan as consideration, so they'll receive a loan in return for whatever value they transferred it at. I don't know, sorry to introduce.
I was just going to add that it's tax-free at the time of the transaction, but it's really tax deferred because it doesn't mean that they're not going to be able to pay tax. It just means that when they actually, because they're keeping the other company's keeping it, so they're still going to pay tax on it. So it's not tax-free, it's tax deferred.
It's tax deferred, so...
so they'll still pay tax upon the future sale.
Yeah, tools will have to be...
Yeah, exactly.
Okay. All right.
With the calculation of the value of the shares that we have previously established, are we in a position to multiply the exemptions for the capital gain, or do we enough values on the shares, the voting shares that only own the preferred shares.
So could you just repeat the question? Sure.
Yes, with the value that we have calculated at 2.3, I'm just wondering if we're beneficiating from one exemption or if we're able to go onto the shares that are held by the trust and also multiply, because I know you've mentioned that we could multiply, and I'm just wondering if we're doing it in this case.
So in this case, so as we mentioned, the lifetime capital gains exemption, like you can take it. So it's I think the fair market value was 2.4 million of the pref shares. So a portion of that, you would have to. So she would use her own capital gain, lifetime capital gains exemption. So she would save 800,000 on the gain. So there would be some tax there upon the sale of those pref shares. However, all the future value from the original estate freeze, I think it was about it was just I think about 1.5 million or so. Approximately, that would be able to use the lifetime capital gains exemption again. So we probably couldn't use the entire amount because it's 800,000 times 4 from the trust, since she'd be using her own on the pref shares. But we'd be able to use approximately 1.5 million worth of the capital gains exemption.
Gotcha.
Yeah.
Thank you very much.
All right.
Thank you. Have a good day. Thanks.
Have a great day. Bonne journée, ça a bien été? Longue journée par là, hein?
Juste pour rappeler que ce qu'on avait parlé c'est un classement de 1 à 12 mots. Puis pour ça, ça prendrait cette feuille-là avec les chiffres marqués par catégorie. On peut déterminer une note sur 100 à attribuer aux universités.
Et on met le rating.
Oui, ben tu peux les mettre par catégorie, là, comme versus